Thank you for inviting me to present this paper that came out very recently, about less than a month ago, joined with Jeremy Benes, a colleague of mine at the IMF. This is the usual disclaimer, and this definitely applies for this paper. This is not an official IMF policy that I am proposing here. This is research and nothing more. Now, introduction. The Great Depression led to profound debates about monetary reform, just like we have them today, but actually it was far more profound than what we have today. If you look at the writings in the 1930s about what level of discussion was there about how we should design our financial system, was actually far more profound than it is today, because a lot of the discussion that we see today is just about tinkering with the plumbing of the existing system instead of redesigning the system from the ground up. Of course, there is room for both. We need that too, but I think it is very valuable to also think about how we could redesign the system from the ground up, which kind of connects to something the previous speaker said. It's nice to be in this session because you only need to talk about the future without being tied down by reality. I'm actually going to do both. I'm going to construct a model that is firmly grounded in how our financial system works today, and then I'm going to present another model. Well, I'm actually not, I don't have time to present it here, but I construct another model that is a hypothetical system under what you call Vollgeld here in Germany, and I'm going to present the transition between the two systems here. So I am grounded in reality. So in the 1930s, some of the most famous economists of that time, Irving Fisher, Henry Simons, later also Friedman, that came in the 50s, supported the so-called Chicago Plan. Chicago, because Simons was from the University of Chicago, Frank Knight also, he was also behind this. This plan separates the money and credit functions of banking by requiring 100% backing by public money for all deposits, absolutely mandatory. And for credit, the stipulation is, credit will continue by private institutions. This is not a nationalization of banks, but credit cannot be financed by the creation of bank deposits ex nihilo. Instead, it needs to be credit that takes pre-existing money and allocates it to various purposes. Some people earlier today mentioned that such a system could be quite inflexible and rigid when there is a need to make more credit available and to be flexible in credit creation, and in fact, my proposal does have that too. It's not the pure version of the Chicago Plan. There is a flexible public option to extend more credit if needed. Now, I'm going to, in the interest of time, I only have here sort of a summary of some simulations and what are the major advantages of the Chicago Plan, but let me give you in 2 minutes just a brief description of what I do in the paper. The paper is 70 pages long. I've never written such a long paper. It's more than twice as long as the longest one I've written before. And the reason for that is that these concepts take some time to wrap your mind around, especially for people who are trained in conventional monetary economics. So I start off with a long section about monetary history, which shows that government money creation over the last centuries, not just the last few decades, has been superior in terms of outcomes because it did not create financial crisis nearly to the same extent that private money creation did. And do not be deceived if somebody tells you that the counter-argument is, well, we've had so many governments over the last few decades that have been irresponsible with money creation. That is a non-argument. It is completely inapplicable. And the reason for that is that these governments were not operating within a system where there was, in fact, public money creation. There was only creation of public bank reserves and public cash, but not creation of the overall money supply. And the distinction between those things is very, very important. So this would not be a counter-argument, like various developing countries over the last 50 years would not be a counter-argument against what I'm presenting here today. So then I build a model. It's a DSGE model. It has over 100 equations. It is solved with general equilibrium techniques. No apologies for that. Unlike some of the speakers who spoke here over the last 2 days, I don't have a problem with equilibrium models. I think, there is something to this equilibrium. It's interesting, but I think we can capture a lot of very interesting and relevant facts by just looking at equilibrium models, and technically it's much, much easier to solve. this is important. You know, we've got to get some work done here, and we got to, and if I tell you that we're capturing 80 or 90% of what we need to know about this problem, then that's good enough for me. The model is certainly theoretically correct, because what I'm doing is I'm taking building blocks from existing monetary economics. We're adding to that one block where an innovative model of general equilibrium banks, which is our own creation, but otherwise I'm putting together building blocks from the cutting-edge monetary economics literature, but I'm putting the blocks together differently from how people have been putting them together so far. And finally, I spent very many pages again on calibration of this model, various financial sector magnitudes, like how large is the credit volume relative to GDP, how big is the leverage of the various actors in this credit creation, spreads that they pay. We spent a lot of time trying to do that right, so that the model that I'm going to present to you today, it's of the US economy, it's a closed economy model. It is not a Mickey Mouse fly-by-night sort of model where the quantities don't mean anything because you never paid any attention to the calibration. We did a lot of attention. So anyway, what are the 6 advantages of the Chicago plan? Well, there are 4 that are already mentioned in a little book by Irving Fisher, which is called 100% Money from 1936. One of the best reads in economics that I've ever done. It's way superior to anything, well, not anything, but most stuff that has been in the Journal of Monetary Economics, for example, over the last few decades, because it is very, very profound, really thinking about the nature of money. Okay? So what are the 4 advantages identified by Fisher? Much better control of bank lending-driven business cycles, complete elimination of bank runs, dramatic reduction of the public debt, net public debt, not necessarily gross public debt, dramatic reduction of private debts. Then when we confirm all these in our DSG model, but we identify 2 more advantages, because we really need to go down to the nitty-gritty and say, you know, what would this do, and then simulate it all out. And we find that in addition to that, the magnitudes can be disputed, but the direction is correct. There are large output gains approaching 10%, steady state output gain of 10%. It doesn't happen all at once, it happens over time, but in the long run, relative to trend, a gain of 10%. And also, in this world, this is really a world where monetarism works in a good way, because you really can control monetary quantities. And by the way, it doesn't make you vulnerable, because if you control the quantity of money, it doesn't mean in this world that the interest rate is going to become very volatile, because you have various other policy tools at your disposal, okay? Such as quantitative lending guidance, such as an interest rate at which the government lends to banks, et cetera, et cetera, et cetera. Okay? So, zero long-run inflation is attainable. You would be in a world without a trend in the price level and without a zero interest rate floor liquidity trap problems. Problems that we're really struggling with today. According to this model, these problems would be completely absent in that world that I'm constructing. So, a little more detail about the 6 advantages. How would we better control bank lending-driven business cycles? The key characteristic of today's banks is money creation and destruction. Intermediation is purely incidental and secondary. It happens as a consequence. It happens as we do money creation and money destruction, but it is not the primary function of banks. If you look at the modern economics literature, there is now, since 2008, a lot of effort that goes into building models with banks. But I have yet to see one that really does anything more than model banks as intermediaries. Okay? DSG models. I'm talking about DSG models. This model does, right? If banks can do this, then they could create lending booms by tomorrow morning. It's not a problem, right? They just make big loans to everybody. If instead bank liabilities were savings rather than money, which the standard models claim, that would be impossible, because savings is a very slow-moving state variable that you need to accumulate over time. Cannot make a lending boom happen with that, okay? Under the Chicago plan, this privilege is basically taken away, because money and credit are no longer tied together by balance sheets. So if I create more credit, I can do that. There's limits on that too. But if I do that, it has nothing to do with what happens to money, right? So I can control money and I can control credit also. Banks do now become true intermediaries. So they do become what conventional thinking imagines them to be today. They have to obtain some public money first before they can lend it out. All right? So that's the first advantage. Complete elimination of bank runs. Should be obvious that a run on money is no longer possible because, you know, the bank has all the money in the electronic vault at the central bank, so to speak. You're not talking about cash, physical cash in this day and age. But it also needs to be true that credit assets must be funded by non-monetary liabilities so that there can be no near monies whereby there can be a run on those rather than on the pure cash. So that means that credit assets would have to be funded either purely by bank equity, by loans from the Treasury. Time deposits are more problematic, although with proper regulation that Henry Simon stressed a lot in the 1930s, this could be done also. Dramatic reduction of the net public debt. To meet 100% reserve backing, banks in our model, based on our calibration, which is realistic, it includes the shadow banking system, would have to borrow about 180% of GDP. So they have to borrow in order to get the money because the money doesn't exist yet. It has to be created, right? So basically, I'm taking a loan to buy the cash that I need to put behind my deposits. So the banks now have a loan to the government, that they owe to the government, that is 180% of GDP. The current public debt is about 80%, well, maybe out of date, it's growing fast, but 80% of GDP is how we calibrated this for the US. Meaning the government would in this world actually become a large net creditor to the rest of the financial system, right? The government can obviously share these gains by transferring. This is like a one-off seigniorage. It's sort of like saying the banks have used this privilege to create money over decades and centuries. And they have, over all this time, this basically seigniorage because they have been printing money instead of the sovereign printing money. This, in one instant, would give the all that seigniorage that the banks have created over time back to the sovereign in one moment. Okay? It's a very large gain that they can share with the private sector by basically paying dividends to the private sector. It is very important to notice, and this came up in the discussion that we saw here earlier, public money is not debt. It is true if you look at how money produced by the Federal Reserve is treated in accounting terms in the US, that is counted as debt. But it's interesting, if you look at how a treasury coin is counted in the accounting treatment of the US, it is treated as equity. Equity not in some sort of corporation, but equity in the Commonwealth, which means all of us, well, all Americans in this case, right? So money, public money, is not a debt of the government because it never has to be repaid, right? In a growing economy, instead, we all know that, in fact, there has to be more and more every period. That's the source of flow seigniorage later on. Right? This is very important to know. We're basically doing a huge debt-equity swap here that makes debt so much less necessary throughout the economy. Finally, dramatic reduction of private debts. The government can cancel treasury credits in exchange for private banks canceling private debts. So that's the sharing aspect that I was talking to you about. There are large output gains. They are due to three things. First of all, when there is a lot less debt in the economy, interest rate risk premium will decrease, and that will give a boost to all sorts of things, including, most importantly, investment. Seigniorage revenue, I'm assuming that this economy is growing at 2% per annum in steady state, and that means the money supply has to roughly grow at 2% per annum in steady state. So you can grow the money supply at 2% per annum without any inflation, because if the money supply grows at the rate of real growth, there is no need for inflation. Yet, when the money supply equals 180% of GDP, 2% of 180% of GDP is 3.6% of GDP, additional fiscal flow revenue without any debt, without any interest. Now, whether these numbers are correct, we can talk about, but the principle is correct. Finally, lower monitoring costs, because in this current economy, what we need to create a fairly large money supply. As I said, 180% of GDP. Depends how you count. Maybe less, more, maybe more. We need to create that money supply where we can only create it through debt. So basically, we need this huge monitoring mechanism out there with our financial system that makes sure that this debt is created in a way that gets lenders their money back, right? It's like a huge pawn shop whereby houses need to be mortgaged and factories need to be mortgaged so that we can have money. But then the banks have to constantly look at, oh, can we get our money back? So lots of people are working on that. If you were to take all that overhead away, you can save, according to our simulations, again, the numbers can be disputed, but you would save over 1% of GDP just in wasted resources that don't need to be there in the first place, because you can create money without debt. Very important. Okay. Zero steady state inflation. The policy tools under the Chicago Plan would be a nominal growth rule for the money supply, standard a la Friedman. A capital adequacy rule that controls the quantity of lending. That sort of mimics a little bit what Richard Werner was talking about earlier, quantitative lending guidance. And an interest rate rule that controls the price at which the government lends to banks, because there's some residual lending there. And with these rules, there can be no liquidity trap because money is directly controlled by the government. So to the extent that it's never quite clear what a liquidity trap means, but one thing that it means is that the broad monetary aggregates cannot be easily influenced and controlled by the central monetary authority. In this case, that's not the case, right? Broad monetary aggregates are directly under the control of the monetary authority. The other thing that a liquidity constraint can mean, a liquidity trap can mean, is that you could be at a zero interest rate floor, so the interest rate cannot become negative. Okay, and then you have no further room to stimulate. Now, the interest rate on treasury credit in our model can be negative without any problem, because it is exclusively a rate at which banks borrow for the purpose of refinancing lending to productive investment and for nothing else. Of course, this requires regulation. Okay. So I'm going to present to you now a simulation of the transition to the Chicago Plan. How much time do I have? Okay, so we're validating three of the claims of Fisher, namely bank runs completely eliminated. That's, as I said, that's trivial. The net public debt goes from 80% of GDP to minus 30% of GDP. Private debts go from 180% of GDP to 90% of GDP. Much less debt, because a lot of it is replaced by equity, which is money. The important additional results, the output gains approach 10%, and inflation falls to zero. So here it is by way of bank balance sheets. On the left, we have the bank balance sheet in the US, approximately, according to our best efforts. So all numbers are in percent of GDP. So you have 184 of deposits, some bank equity there, 80 investment loans, 100 other various kinds of loans, and some government debt. What does the Chicago Plan say? The Chicago Plan says this stuff needs to be backed by public cash. And so I need to procure public cash from the government, reserves. These are these reserves. How do I procure it? I borrow it from the Treasury. The Treasury charges me a little bit of an interest rate on that. That can be a subsidized interest rate, and it's a policy decision what that interest rate is going to be. Okay? So all that has happened is that we have made our balance sheet longer by 184% of GDP. And then the second step, which can be either in the model, I'm assuming it's implemented immediately, but you can also implement it over time. It will probably be better, because this could be messy to do this all at one time. Basically, then what we're saying here, the deposits and the reserves are still there, right? That's still the same. So now we have fully backed currency, fully backed by public cash. And this is a thick line, and that means that that's sort of like there's a big Chinese wall here. It's like a triple Chinese wall. This is a separate aspect of the banking system. This is the lending part of the banking system, where with a reduced equity, because there's now less lending activity, the banking system has investment loans of 80 still outstanding. They are now fully financed by Treasury credit. Okay? And then there's some other stuff going on, which is investment trusts that do some lending and borrowing also, but it's purely non-monetary. That's a purely investment vehicle. And this Treasury credit, by the way, I have to emphasize, can be made quite flexible. So when lending for productive activity is concerned, the economy does not need to be tightly constrained by the money growth rate rule a la Friedman, and can flexibly inject additional credit if the government deems this necessary. So this avoids a little bit that straitjacket that otherwise full reserve banking can impose. This is the government balance sheet. So I don't know what the assets of the government are. I'm just, I wanted the balance sheet to balance, and it starts off with 80 of government bonds. Then This transaction adds reserves here. This is new equity of the government, and it has a claim of treasury credit on the banking system. And this now is basically what it's going to do next. It's going to transfer some of these claims on the banking system to private agents on the express understanding that that money has to be used, not money, that claim has to be used to repay outstanding debts. And so then that means, of course, it's a write-off against equity, so the equity is somewhat reduced, but we still end up, at the end of the day, with a vastly reduced debt of both the government and the private sector. Here are some simulations of the main macroeconomic variables. What we have on the horizontal axis is quarters, and it goes up to 60 quarters. And the first thing to notice is in the second row, all the interest rates drop dramatically. It depends a little bit which one you're looking at, by about 5%. It starts off with nominal interest rates on treasury bills of 6%, right? Now, part of that is always due to an equilibrium real interest rate, which was 3%, and the other one is due to inflation, which was 3% in the initial steady state. And the reason why these rates now fall is because both the real interest rate and inflation fall. Inflation falls because it falls because, I told you, it can fall in this economy without posing problems for the conduct of monetary policy, and real interest rates fall because debts have fallen, and therefore the spreads on debts, etc., etc. Now, much lower real interest rates, of course, mean that that there will be a big spur to investment. So investment in this particular simulation, again, we can talk about the numbers forever, but not about the principle, goes up by 25% in the long run. There will be some crowding out of consumption here in the short run, but not in the long run. And then GDP in the very, very long run, this takes quite a long time until it gets there, increases by almost 10% of GDP. Here we have something else that's very important for the real effects. And I'll show you why on the next page. All the tax rates drop quite dramatically. Labor tax rate and capital tax rate by around 4%, and the consumption tax rate by percentage points, and the tax rate by around 1 percentage point. Why is that? Let's look at the fiscal variables. So we have the government debt drops, only the gross government debt goes from 80 to 60. The rest remains outstanding, but it's now more than offset by these claims that the government has on the banking system. The debt service, of course, goes down a lot. The deficit goes down a lot. This is partly due to the fact that there's just lower inflation. So for any given debt, when there's lower inflation, the deficit is lower. But the most important thing is that we have here this seigniorage income, the 3.6% of GDP that I explained to you earlier. By the way, bear this magnitude in mind. Some of the people who spoke before me were sort of saying that it is almost an unlimited pot of money that I have by printing more money. I would have my doubts over this. I mean, I get that it's 3.6% of GDP on the basis of a fairly radical plan that has, you know, where I am making loans to the private sector or have a money stock of 180% of GDP. So it's very significant, but it's not unlimited. So this seigniorage revenue is then used to basically reduce the tax take. And these taxes are all distortionary, so this has a positive effect on GDP. And we're assuming that all taxes are affected in similar ways. And then I have, I think, 3 more slides, so I think we should be okay. Credit booms and busts. So the fourth of Fisher's claims is that boom-bust cycles are eliminated, right? What we find is that, yes, but we really need something like what Richard Werner advocates, which is a quantitative lending guidance. Possibly doesn't need to be that strong, but it is something we're thinking about. Now here, I think I'm going to have to make this bigger so that we can see individual magnitudes. So here what we have, the black line is the, now here this is not a transition. This is a business cycle simulation where I'm saying, okay, banks suddenly, for whatever reason, become a lot more optimistic about the state of the business cycle. They want to lend more money, just out of the blue, where they wake up and they're happy, right? And so they start lending. And basically specifically I'm assuming that they think their borrowers have suddenly become less risky. Not necessarily with a real-world counterpart to that. It's all in their heads, right? And so the black line is then the existing banking system, the way we modeled it, The blue line is the Chicago plan world, but without quantitative lending guidance. And the red line is the Chicago plan world with quantitative lending guidance. So basically what we see, I'm assuming that for about 3 years, I think it's more like 2.5 years, basically these banks lend a lot more. Okay, 50% of GDP under the existing system, and this is because under this system there's still a lot of mortgage loans. And mortgage loans can be expanded almost immediately because there's a lot of housing stock out there and you just need to pawn it, right? Not a problem, right? And so bank loans increase dramatically, and then I'm saying that after 2.5 or 3 years, suddenly banks wake up and they're not happy, right? And so they say, oh shit, what have we done here, right? And so they start to, and I've been a banker, I've done this, and I've been involved in something exactly like that in the UK in the late 80s, okay? And so what happens is that at that point, the loan stock suddenly contracts dramatically, right? And under the existing system, bank deposits contract dramatically, and et cetera, et cetera. And at that point, GDP also takes a nosedive. And why does it take a nosedive? This is essentially because the banks are taking a big hit to their equity, and now they need to earn their money back to stabilize their balance sheet again. So they're jacking up their lending rates, and we can see that here. The wholesale lending rate goes up, the lending rate that include risk premia go up, et cetera, et cetera, et cetera. The economy immediately starts to tank, and this was based on nothing more than the banks waking up happy and then later waking up unhappy, okay? And so then the question is, how badly can different systems stabilize the economy? And we see, and in the interest of time, I'm only going to look at GDP. The existing system has a big crash. The system without quantitative lending guidance under the Chicago plan also has a big crash. But when you have quantitative lending guidance implemented here by way of capital adequacy regulations, the same thing does not happen. And basically what happens here is that during good times, banks are forced to accumulate a lot more equity so that they are ready for bad times. And that prevents them from lending too much in the first place. They no longer have an incentive to expand lending as much when they're happy. And so when they start to get unhappy, that's no longer such a big problem. Okay? So now I want to go back to the previous view. Okay. So this is my last slide, so how is that for timing? So our conclusion, our aim was to examine the 1930s Chicago plan in a modern DSGE model calibrated to the modern US financial system, which is much larger than it was in the 1930s. Our tool, I already said that. Our result, transition to 100% reserve banking and a treasury plus equity funded banking system would have dramatic benefits that go even beyond those emphasized by all these illustrious names that I have listed here. Several of these authors also emphasize that the transition to such a system can be technically quite straightforward. And I think that's not as true in the 1930s today, it is not as true today as it was in the 1930s, but it is nevertheless true. I mean, basically what happens is, you know, the transaction of acquiring the reserve backing can happen in an instant, right? The next transaction of the debt forgiveness and the debt write-off is also technically, if everybody's accounts were in a central register of debts and of debits and credits that everybody has in the economy, then it's purely an accounting entry. You could give everybody a per capita equal dividend, or if you want to do something redistributive, you can do that too. You make these dividends, and you say that these dividends can only be used to repay debt, and then you repay the debt. And after that, anything that remains is either in this remaining banking system or it's in these investment trusts that no longer have anything to do with banking and money creation per se. They're just investment vehicles. Okay? Now, many details of this analysis, as I'm saying here, should be debated and refined, and that's why I come to places like this. I want feedback. I want people to criticize the details, and I've already started to do that with people who've been very interested, even in the policy community, that has already started. And obviously, this is at a very conceptual level. When it goes down to the nitty-gritty and how do we actually do this in practice and what are the legal implications, blah, 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 that's something that still needs a lot of thinking. But there are people out there who have already done some of that thinking. Thank you very much.
Thank you very much. Thank you very much, Michael, presenting your latest research to us. We appreciate it a lot. We have a very shortage of time and we are really sorry that you had to skip some parts. And we have very short time for questions only. They are possible in English and German. And I would say that we collect them until Michael decides to answer. And we have just really 5 minutes left. So I see 1, 2. Yeah, please. Oh, yeah, okay.
Zunächst ein Kommentar. Ich glaube, die Aussage, dass die Steuern dadurch sinken, ist zumindest irreführend, denn über den Seigneuragegewinn, der durch das Geld entsteht, das die Bank oder dass der Staat oder die Notenbank den Banken gibt und dafür Zinsen kassiert, ist ja nichts anderes letztlich als eine Steuer auf die Kredite, die die Banken vergeben. Also es wird nicht Steuer gespart, sondern es wird möglicherweise herkömmliche Steuer ersetzt durch einen Seigneuragegewinn, der faktisch nichts anderes ist als eine Besteuerung der Kredite oder Guthaben, wie immer man das sieht. Das ist der Punkt 1. Der Punkt 2, ich habe nicht verstanden den wesentlichen Unterschied zwischen Fischer 100% Geld und eurem neuen Vorschlag. Was ist der Kern dessen, was technisch der Unterschied ist?
I got 2 questions. The first is on the bank run argument. I think as long as banks are intermediaries and do pass on credits to people, and there could be a risk of credit default, why should there be no risk of bank run? I do not understand why there couldn't be a situation where people see that the bank has a credit default and go to the bank, and of course it's not all in the bank, all the money. That's the first question. The second is on the general thing about the credit creation. You said the banks create credit out of nothing, but it's not fully right. They create out of nothing if they find someone who takes the credit. So, and finally, you have a situation where as long as they find people to take the credit, they will just create money. If you have the need also, or you want also to create the credit because there's a need for it, will you not finally end up in the same amount of credit if it's just created by public intervention or whatever?
Nächste Frage vom Podium. Die Geschwindigkeit der Anpassungen. Wie lange dauert die Übergangsperiode, Transition Period? Sie sagen, dass die Resultate sind sehr robust. Stimmt das auch für die Länge des Übergangszeitraums oder hängt das davon ab, wie Sie das Modell kalibrieren?
Und von mir auch noch eine Frage.
Dann sollten wir auch aufhören. Sonst.
Danke, dass Sie meine noch zulassen. Wir haben uns vorgenommen, in diesem Jahr Reformoptionen darauf zu prüfen, inwieweit sie dem Wachstumszwang etwas entgegensetzen können, den wir im Geldsystem mehr als vermuten. Jetzt haben Sie gesagt, dass in Ihrem System die Geldmenge letztendlich ja exogen gesetzt werden kann, vorausgesetzt es finden sich die entsprechenden Investitionsmöglichkeiten. Wenn es möglich ist, die Geldmenge und eben den Zins exogen zu setzen, ihn auch unter den Zero Lower Bound zu drücken, sehen Sie dann in Ihrem Modell auch eine Antwort auf die Frage nach dem Wachstumszwang. Können Sie den Wachstumszwang damit vermeiden und den Zins also den Realzins auf Null drücken und damit auch die Wachstumsnotwendigkeit auf Null absenken? Ist Ihr Modell tauglich für eine Steady-State Economy?
Okay. Well,
please answer because it was the last question. We have no time.
That's a good question. So I'm not sure I understand your first question. So let me rephrase what I wanted to say. Okay. So what I have in the model is a government that has a fiscal policy rule that says that the deficit to GDP ratio, not the primary deficit, but the interest-inclusive deficit to GDP ratio, is equal to some number plus some response to the business cycle, if you wish, right? And so what happens if I have more seigniorage income, then this rule will tell me that I can take in less revenue elsewhere and I will still satisfy that rule, okay? And so what the model assumes is that it takes in less tax revenues. Okay, so that's just fiscal accounting, right? Okay. So the question is whether this seigniorage is as distortion. I think the other aspect of your question is, isn't this seigniorage also a distortionary thing?
It's another form of a tax.
Yeah, but it is generally held. I mean, if it doesn't take the form of an inflation tax, which this one does not, remember, because inflation is zero, then this is generally not nearly as distortionary as taxes on labor or capital income. So in terms of stimulating economic activity, I think there's a net gain here. But we can argue about this because that to some extent depends on how you model the rest of the economy. In terms of what are the differences to Fisher? Well, in conceptual terms, what I did is I took the Fisher 1936 book, which is all words, right, but very clever words, and I tried to say, I tried to say, can I model this? So in the sense, it's not different to Fisher in the big picture, right? We're just taking this and putting it into a model and showing that what he says is actually right. But of course, in doing so, we get a number of additional implications that he wasn't able to get just with words. But there are some important differences in the details, but the details can be changed. Like one of the details that we have here is that the remaining credit part of the banking system functions entirely by being refinanced by public credit, right? Whereas whereas Simons, for example, was talking about time deposits remaining in the banking system, so there would be the banking system would finance credit partly by time deposits. He was very worried that such time deposits could become near monies, and therefore the whole control of money would be lost again. And so that's why what we said, okay, let's go away from that. Let's capture everything, right? So that there cannot be any financing of credit by private sector deposits. So none of this can become near monies. And one way of doing that is by doing it by having the government financing everything. The other way of doing it is by the banking system having to be 100% financed by equity, right? That's also a possibility, which we didn't do. The third one is to go with time deposits, but then you need a lot of additional regulations to make sure that these cannot become near monies.
It's 3 minutes maximum. Please.
Why is there no risk of a bank run? Well, on the money part of banks' balance sheet, there is no risk of a bank run because that's just a warehouse, right? There cannot be a bank run on this, or well, there can be a bank run, but it would be kind of pointless because you know the bank. Okay, let's say. There's no risk to the macroeconomy from this because the banks, all they do is they pay out the money, right? It's not, they don't need to liquidate loans to pay out that money because it's just an electronic entry in the central bank. And so there's no risk that this would lead to any kind of dislocation in the economy if people suddenly all come back to the bank and say, I want my money back, okay? And in fact, I mean, but strictly speaking, given that it is money, it is public money and not a bank deposit, they cannot even actually ask for their money back because it is understood that money can only be transacted between them, right? Unless the government deliberately wants to do an open market operation, you cannot take your money and go back to the government and say, I don't want this money anymore. The government says, no, because this is not my debt, this is not something I'm obliged to take back, this is equity in the Commonwealth, okay? So this is very important. About the amount of credit, would it be the same under the old and the new system? It's possible. I don't know. The incentives are different because taxes are different and interest rate risk spreads are different. What mostly matters here is the implications of doing this for public finances, for debt levels, etc., etc. This has big implications for real interest rate. This has big implications for tax rates. And you know, the fact that in the end this system might satisfy the existing credit demand at the same level or a higher level or not, that's not the most important thing. The most important thing is the implications it has for finances, for interest rate levels, because you're basically doing a big debt equity swap in this economy. Does the transition period make a difference? Good question. It would be really hard to simulate the transition period if it took more than one period, and I opted for a clean exposition that doesn't, you know, it would get messy in terms of it could get messy in terms of the impulse responses. It's a little bit arbitrary of how long you make the transition period. So I just say, conceptually, let's just look at if this happened immediately, and you can see all the important things are there, right? Because, you know, you're going to a new steady state, and most quantities go close to that new steady state almost immediately if you do it immediately, and otherwise it would be more gradual. So I think here you should build simple models and simple simulations, and I did it as simply as possible, but I think it's certainly worthwhile to think about doing it more gradually. And as I said, in some sense it might actually be preferable to do it more gradually, especially you don't want to pay a huge dividend out to everybody all at once, because that might lead to some pressures. As in the last question, very briefly, can I say something about the pressure for growth developed by or generated by the way our finance system is set up? And the answer is no.
Thank you very much, Michael. That was great and inspiring.